Committee will come to order. Without objection, the chair is authorized to declare a recess of the committee at any time. This hearing is entitled Examining Capital Regimes for Financial Institutions. Before we begin, I'd like to thank the witnesses for appearing today. We appreciate your participation. And quite frankly, everybody's jealous of our panel today. We've got a very, very distinguished panel. Thank you all for being here, and we certainly look forward and anticipate your testimony. I now recognize myself for 5 minutes for purposes of delivering an opening statement. Last April, this subcommittee held a hearing to examine the state of federal financial regulation and the impact regulators and their respective regimes were having on institutions, their customers, and the U.S. economy. Sitting on the front row of the dais were stacks of paper representing 20 to 30,000 pages the average bank submits to the Federal Reserve for annual CCAR review process. That's 20 to 30,000 pages per bank per year, just for CCAR. Fast forward a little more than a year, and I'm pleased to report that the first time in a long time, progress has been made and some relief has been granted. Thanks in large part to the effort of the committee members, the members of this committee and our colleagues in the Senate, and a president who champions regulatory reform. CCAR doesn't burden nearly as many institutions as it did 1 year ago. While some relief has been seen, it's widely recognized that there is more work to be done. In a January speech, the newly minted Federal Reserve Vice Chairman for Supervision, Randy Quarles, outlined his vision by stating that, and I quote, "Simplicity of regulation is a principle that promotes public understanding of regulation, promotes meaningful compliance by the industry with regulation, and reduces unexpected negative synergies among regulations. Confusion that results from overly complex regulation does not advance the goal of a safe system," end quote. Vice Chairman Quarles went on to indicate support for changes to the resolution planning process and stress test programs, acknowledging substantial progress made by financial institutions in the last few years. His quasi-predecessor, Governor Dan Tarullo, said in his departure speech last year, and I quote, "The time may be coming when the qualitative objection in CCAR should be phased out and the supervisory examination work around stress testing and capital planning completely moved into the normal year-round supervisory process, even for GSIBs," end quote. While we didn't agree on much during his tenure, Governor Tarullo and I had at least one thing in common, the idea that capital is a good thing. Capital protects institutions and more importantly, consumers against loss and guards the financial system against threats of collapse. While I believe in robust capital requirements, I don't think capital should be required to the point that it consolidates risk and eliminates choice in the marketplace for commercial and individual clients. The reality is that we still live in a world where the financial regulatory regime stifles growth and limits the availability of financial products. The new crop of federal financial regulators, in an effort to right-size regulation, are considering additional measures, including tailoring to provide relief to institutions of all sizes. As they do so, I would first urge them to implement the statutory changes included in Senate Bill 2155 without delay, and do so while closely adhering to what is clear congressional intent. It's time for the Federal Reserve to also conduct a holistic review and acknowledge that the world has changed since the enactment of Dodd-Frank and the finalization of the capital requirements on the books today. Such a review should include a consideration of equal and reasonable treatment for institutions with more than $250 billion in assets and for immediate holding companies or intermediate holding companies of international banks operating in the United States. These institutions should be subjected to tailored regulation that reflects the risk they pose to the financial system. Such steps would not only reflect the intent of Congress, but also the administration, evidenced most clearly through the recommendations issued by the Treasury Department since President Trump took office. It's time to take the guessing out of capital planning and regulation. I press leadership at each of the federal financial regulatory agencies to recommit to greater transparency and adherence to the requirements in the Administrative Procedures Act. We need smarter, streamlined regulatory regimes that promote not just transparency, but also effective taxpayer and systemic protections. We have a very distinguished panel of witnesses before us today. Each of these gentlemen has a notable background, and we appreciate their testimony. The chair now recognizes the ranking member of the subcommittee, gentleman from Missouri, Mr. Clay, for 5 minutes for an opening statement.
Thank you, Mr. Chair, and thank you for conducting this hearing. At this time, I am going to be going back and forth to a business meeting in the Oversight and Government Reform Committee. We are expecting votes, so I will designate Mr. Scott of Georgia as the ranking Democrat on the panel, and I yield to him for his opening statement.
Very good. We'll recognize Mr. Scott for an opening.
Thank you, Mr. Chairman. Thank you, Mr. Clay. As was pointed out by the chairman in his opening remarks, it's important for us to remember that stress tests are an important tool that we armed our regulators with in the aftermath of the terrible financial crisis. And we did that so that regulators can test the health of our country's biggest banks. And I was back then, and very proud of the fact that I was an original co-sponsor of Dodd-Frank. And I'm proud to say this, that if it weren't for the more stringent capital leverage requirements that we put in place, our financial system wouldn't be as safe as it is today. These changes have also made our banks more resilient, and they've led to increased bank lending, which helps spur our great economic growth that we are experiencing today. These changes also have made our banks more active in getting the necessary capital out into the marketplace. But as I've been saying for quite a while in numerous of our committee meetings, no law is perfect. And that's to say Dodd-Frank is not perfect. And we as lawmakers cannot be unwilling to look at these Dodd-Frank rules simply because they are too politically difficult to discuss. Our banking system needs us to do that. That's why I became the Democratic lead on Mr. Zeldin's Stress Test Improvement Act, H.R. 4293. We have a distinguished panel. We're looking forward to your interesting and helpful comments. And thank you, Mr. Chairman. I yield back.
Gentleman yields back. With that, we go to the testimony of our witnesses. Today, we welcome Honorable Kevin Frommer, President and CEO of Financial Services Forum, the Honorable Greg Baer, President and CEO of Bank Policy Institute, Dr. Douglas Holtz-Eichen, the President, American Action Forum, Dr. Marcus Stanley, Policy Director, Americans for Financial Reform, and Mr. Keith Norica, Partner at Simpson, Thacher, and Bartlett. Each of you will be recognized for 5 minutes to give an oral presentation of your testimony. Without objection, each of your written statements will be made part of the record. Just a quick tutorial on the microphones in front of you. Please pull, that whole thing will come forward. All you can do is just pull the whole thing forward to make sure the microphone's close. It's very sensitive, so red means, or green means go, yellow means you got a minute to wrap up, and red means we need to close down altogether. So with that, Mr. Frommer, you're recognized for 5 minutes.
Thank you, Mr. Chairman. And Congressman Scott and members of the subcommittee, thank you for having this hearing and thank you for the opportunity to testify today. My name is Kevin Frommer and I'm President and CEO of the Financial Services Forum. Our members are the 8 largest and most diversified financial institutions headquartered in the United States. And we welcome the opportunity to discuss our support for a broad review of U.S. capital regulations, as well as a more targeted review of the capital planning process, the leverage ratio, and the capital surcharge, which applies to only our members. The Forum's member firms provide vital services in support of the U.S. economy. In the first quarter, Forum institutions held more than $4 trillion in loans, accounting for 44% of total lending to businesses and households. Our members also underwrite nearly 3/4 of debt and equity transactions among other large U.S. institutions, providing critical services that other institutions cannot provide on a similar scale. Our institutions have significantly enhanced their resiliency and resolvability over the past decade, and they are strongly positioned to support economic growth throughout the economic cycle. Notably, they maintain more than $900 billion in Tier 1 capital, a more than 40% increase since 2009. Our member institutions also have significantly improved their liquidity positions, holding nearly $2 trillion in high-quality liquid assets, an increase of more than 85% since 2010. Our members maintain strong capital levels, and they support capital standards that promote both stability and economic growth. Since capital is a more expensive form of bank funding, Unwarranted increases in capital standards lead to increased costs of borrowing and reduced availability of loans for consumers, businesses, and communities. To foster economic growth, it is imperative that capital standards be appropriately calibrated to effectively balance costs and benefits. Regulators worldwide have issued many new requirements at a significant pace in recent years, necessarily focusing on each measure individually. With nearly a decade of change and experience and data behind us, now is the time for a holistic review of the interaction of these important but separate actions. Regulators here and abroad have already begun that process of reviewing and adjusting the post-crisis regulatory system to make key rules operate with greater transparency and efficiency. An important initial step in this regard was a series of recommendations made by the Treasury Department last year. In my testimony, we call for a broad review and highlight our views on targeted near-term steps. The Federal Reserve this year proposed to integrate its capital regulatory rule with its capital planning and stress testing regime, while establishing a new stress capital buffer. In addition, 2 federal banking agencies proposed to revise the enhanced supplementary leverage ratio, which applies to only our members. These efforts, which we appreciate, seek to maintain strong capital adequacy while reducing the complexity, cost, and unintended consequences of the regulations. The forum has offered suggestions for improving these proposals. First, the forum believes that the stress capital buffer proposal should be modified to ensure that boards of directors at financial institutions can clearly and appropriately make capital management decisions. A firm with capital in excess of the Federal Reserve's requirements should be permitted to make capital distributions in the way its board deems most productive. The Federal Reserve should also improve the transparency of its scenario and model designs by, for example, soliciting public comment on its stress scenarios. Finally, the Federal Reserve should conduct a fulsome analysis of the effective costs and benefits of the proposed stress capital buffer proposal that accounts for the full range of its economic costs. Secondly, with respect to the enhanced supplementary leverage ratio proposal, we have recommended that the agencies exclude risk-free assets to eliminate the economic incentive to reduce participation in low-risk, low-return businesses. These changes would also serve the agency's stated goal of ensuring that leverage requirements serve as a backstop to risk-based capital, as opposed to a binding constraint. Finally, both the stress capital buffer and leverage proposals import the GSIB capital surcharge, which again only applies to our members. This surcharge was finalized in 2015, 3 years ago, in the absence of several very important improvements to the regulatory system. In conjunction with our colleagues at the Bank Policy Institute, we have analyzed the level of the GSIB surcharge and find that it is overstated by at least 1% because of subsequent additional regulatory requirements, which both reduce the risk and the impact of default to the financial system. Accordingly, we believe that the GSIB surcharge should be reconsidered. This is an initiative that would be wholly consistent with the stated intent by regulators to re-examine and re-evaluate the efficacy and efficiency of the post-crisis regulatory regime. We look forward to continued engagement with the Congress, with regulators and other stakeholders to achieve a balanced system that seeks the goals of a safe and sound system with one that best supports economic growth and job creation. Thank you.
Mr. Barron, you're recognized for 5 minutes.
Thanks, Chairman Luetkemeyer, members of the subcommittee. Today is my first testimony on behalf of the new Bank Policy Institute. Our new organization will conduct research and advocacy on behalf of America's leading banks, which will also serve the interests of consumers who desire innovative products at competitive prices and businesses who seek funding for their growth. The stakes are high, as our members make 72% of all loans and 44% of all small business loans. Turning to capital regulation, U.S. banks now hold substantial amounts of high-quality capital. Since the global financial crisis, BPI's 48 members have increased their collective Tier 1 common equity from nearly $400 billion to almost $1.2 trillion. As a barometer for just how much capital the largest banks are carrying in 2018, consider this year's CCAR results. I should note that BPI's smaller non-CCAR banks have even higher capital ratios than the largest. The scenario included a sudden increase in the unemployment rate of 600 basis points and a stock market crash of 65%. Housing prices plunged 30%, and a similar shock hit capital markets. Using the Federal Reserve's own monetary policy projections, we calculate that such a rapid increase in the unemployment rate alone, leaving aside all the other shocks, has only about a 50-50 chance of occurring once every 10,000 years. And yet, in this year's CCAR exercise, banks ended up highly solvent, holding a ratio of Tier 1 common equity to risk-weighted assets ranging from 4.0 to 16.2%. Overcapitalization of the bank sector matters because every major evaluation of the cost and benefits of capital requirements, including those done by the Basel Committee, the Federal Reserve, the Bank of England, and the IMF, finds that lending declines with higher capital requirements. The only debate is how much. Another underestimated adverse consequence of capital regulation stems from volatility. We frequently hear from bank CFOs that capital planning is extremely difficult when capital requirements vary dramatically year to year, whether from CCAR stress testing scenarios and model changes or examiner pressure. A final overarching concern is the credit allocation inherent in today's regime. One bank CFO recently remarked to a colleague that he is no longer in the banking business, but rather in the regulatory optimization business. In other words, choosing business lines not based on the bank's own estimate of risk-adjusted returns, but rather on how they are treated by capital or liquidity regulations. At the moment, the federal banking agencies are considering a variety of rules that could ameliorate or exacerbate these issues. One pressing concern is how the agencies will adopt the new CECL, or Current Expected Credit Loss Accounting Methodology for loan loss reserving. CECL was originally proposed by the FSB as a countercyclical measure. However, the strong sense of our banks, now validated by a study we have just published this week, is that it will have precisely the opposite effect. As a result, any future recession will be far less unless the bank regulators take offsetting action. More immediately, S2155 revised the thresholds for imposing enhanced prudential standards in 3 ways. First, institutions under $100 billion are no longer subject to enhanced prudential standards, full stop. Second, institutions between $100 and $250 billion in assets will become exempt from most of those standards in 18 months unless the Federal Reserve determines otherwise by rule or order. This review should include living wills and, as Vice Chair Quarles recently indicated, the LCR. Third, 2155 requires the Federal Reserve to differentiate how it applies any enhanced prudential standard based on the firm's complexity. We believe that as the Fed considers how to implement 2155, it should suspend application of many of the enhanced standards while it decides what to do. I should also note that tailoring should include international banks headquartered overseas and doing business in the United States. Their U.S. regulation presents unique issues, as such a firm might be a GSIB in Europe, but a regional bank in the United States. Yet current regulation does not consider those issues in a nuanced way. In April, the Federal Reserve and OCC proposed to revise the enhanced supplementary leverage ratio. We generally support that proposal, as it would return the leverage ratio to serving as a backstop. We also generally support the Federal Reserve's recent proposal to simplify capital requirements, whereby any stress capital buffer is added to a steady state minimum capital requirement rather than being run as an annual pass-fail exercise. Nonetheless, we believe that before the Fed finalizes such a proposal, it must remedy fundamental problems with its stress testing regime and resolve significant methodological problems with the GSIB surcharge. In particular, the Fed operates CCAR using a mono-model, mono-scenario approach, which we believe produces an inaccurate picture of risk, produces unjustifiable volatility, concentrates risk, and allocates capital, principally away from small businesses, LMI borrowers, and capital markets activity. All in all, it's a lot for regulators in this committee to consider. We hope to help and welcome your questions.
Thank you, Mr. Baer. Dr. Holseeken, you're recognized for 5 minutes.
Thank you, Mr. Chairman, Congressman Scott, and members of the committee. It's a privilege to be here today. I want to applaud the committee's efforts at continuing to optimize the capital regimes that face U.S. banks. Unquestionably, Dodd-Frank produced a better capitalized banking sector and one that's safer, but it did so at some fairly well-documented cost. It's an enormously expensive regulatory initiative. It's cost about $40 billion to comply all right, and the tab goes up every year. In part because of those costs, we have seen only a handful of new banks enter the market in the United States, something that I consider a very troubling development from the point of view of competition in the banking sector. On top of that, we've seen a documented decline in the access of small businesses to credit. and that has a spillover impact on the capacity of those businesses to grow, to hire people, and to improve the wages of our labor force. At the other side of the market, we've seen a loss in some consumer benefits like free checking accounts. And I think overall, there's an increasing body of evidence to suggest that Dodd-Frank came at too high a cost for the benefits that it produced. So I applaud the recent efforts of this committee and the Congress in the Economic Growth, Regulatory Relief, and Consumer Protection Act, which tailored the regulatory regime to take some of those costs off smaller banks, which will reverse some of the impacts that we've seen. But I don't think that leaves us with no work left to do. I think there's some things that I'd highlight out of my written testimony. Number one, among the attributes that Dodd-Frank emphasized in thinking about capital regimes was macroprudential regulation or systemic risk issues. To my eye, there has been no real success in identifying a good measure of systemic risk that regulators can target and appropriately manage. Instead, that regime has turned into simply a second layer of prudential regulation. I would encourage the committee to think about holistically reviewing all of those efforts from the point of view of having only a single layer of prudential regulation that actually works. And in that regard, I want to commend the Federal Reserve for its use of stress tests. Stress tests are a very powerful tool to look at the capacity of institutions to weather financial distress and economic downturns. When done well, that is to say with sufficient transparency, reliance on more than a single scenario, they can accomplish great prudential regulation by allowing the stress test to reveal the complexity of a bank's activities and its capacity to weather those difficulties. So I would encourage them to use more stress testing as a bulwark of the regime, not less. And certainly, at least to my eye, this has the additional advantage of bringing market discipline as a complement to the regulatory regime. If stress tests reveal that an institution is weak, markets will identify that weakness, they will price it appropriately, and they will bring pressure on that institution to correct its capital backing, and there's no substitute for good capital to survive downturns. So I think that's a place to focus going forward. And I also think that those tests should be conducted not as part of having a Federal Reserve tell banks how they can use their money. They should be tested to say, is this bank sufficiently capitalized to operate safely in the United States? And past that, they should be able to do whatever dividends and other cash distributions they see fit with their money. And so we've made enormous progress. That progress has come with some of a price in terms of growth and benefits to consumers and small businesses. We can continue to make progress, and I'd encourage the committee to continue to work on that.
Thank you, Dr. Holtz-Eakin. I appreciate your comments. Dr. Stanley, you're recognized for 5 minutes. Welcome.
Thank you, Chairman Lutkemeyer and members of the subcommittee for the opportunity to testify today. Today's hearing examines capital regimes for financial institutions. In thinking about regulatory capital requirements, I believe it is important to start with first principles. This begins with understanding that large banks receive extensive backing from the federal government. According to the Federal Reserve Bank of Richmond's latest bailout barometer, almost 80% of the liability of all banking institutions, or $15 trillion, benefits from an explicit or implicit promise of support from the taxpayer. This support ranges from deposit insurance to the kind of long-term emergency assistance that was provided by the Federal Reserve and Treasury during the financial crisis and continues to be authorized under the Dodd-Frank Act. Public guarantees are a cornerstone of the modern financial system. I guarantee you that if any member of this committee advanced legislation that significantly cut back on those public guarantees for the financial system, the very same people who ask you for less regulation today would be in your office tomorrow opposing that bill. Given the government guarantees provided to for-profit entities in the financial sector, it is important to require that these private entities put up significant resources of their own, especially by investing their own private equity capital. In the absence of such capital requirements, companies could take advantage of low-cost funding made possible by guarantees, government guarantees, and take the profit upside while leaving losses to be covered by the taxpayer. That is what we saw in the 2008 crisis. Even with post-crisis regulatory capital requirements in place, banks are able to borrow much more than any other private sector business could. A private non-financial firm might be able to borrow an amount equal to half its assets. An aggressive financial firm outside the public safety net, like a medium-sized hedge fund, would typically borrow 60 to 80% of the value of its assets. But the large banks at the center of our financial system today all routinely borrow amounts over 90% of their total asset value. Simple math says that the less capital these banks are required to invest, the greater the profit return on each unit of equity. So the easiest way for large banks to increase their return on equity is to convince you, the legislators, to reduce their required levels of capital. To do this, they make two arguments. The first argument is that you should be complacent, because the current requirements for capital and other loss absorbency are so far in excess of any possible losses from a financial crisis that there is no way that 2008 could ever happen again. Of course, no one expected 2008 to happen before 2008 either. The second argument is that you should be alarmed because the current regulatory capital requirements impose severe costs on the economy. Both of these arguments are mistaken. First, you should not be alarmed. Bank lending, especially business lending, is growing significantly faster than general economic growth, which indicates that the banking sector is not acting as a drag on economic growth. Capital is a resource that is actively deployed. Capital supports lending, making lending safer and more durable. Better capitalized banks lend more during downturns. To the extent capital does increase bank costs, reasonable estimates of the economic cost of increased capital are already routinely taken into account by regulators in setting bank capital requirements. Multiple impartial studies show that current requirements are, if anything, too low compared to their economically optimal level. You should also not be complacent. While bank loss absorbency has increased from the disastrously inadequate levels observed before the financial crisis, it is still far from clear that it is sufficient to fully protect against the risk of another financial crisis. However dramatic the macroeconomic variables used by the Federal Reserve in stress test scenarios, the underlying stress test models that project scenario losses are still showing estimated losses much less than those actually experienced by banks during the financial crisis. And most of all, you must not be complacent because of the devastating economic impacts of financial crises. The last crisis created some $10 trillion in direct economic costs in the U.S. alone, 9 million lost jobs, millions of families foreclosed from their homes, and shook the legitimacy of both our economic and political system. It must not be permitted to happen again.
Thank you, Dr. Stanley. Mr. Norica, you're recognized for 5 minutes. Welcome.
All right, Mr. Chairman, Ranking Member Scott, and members of the subcommittee, thank you for having me here today. During 2017, I had the honor to serve as the acting comptroller of the currency. Today, I hope to give you my perspective as someone recently familiar with both the concerns of the public and private sectors. I will focus my remarks on the need for tailoring for two important segments of the financial system. First, regional banks with between 100 and 250 billion in total consolidated assets. And second, international banking organizations that have a banking and capital markets presence in the U.S. In Dodd-Frank, Congress stated that the Federal Reserve, quote, may differentiate among companies on an individual basis by category, taking into consideration their capital structure, riskiness, complexity, financial activity, size, and any other risk-related factors. Despite this invitation to tailor, the vast majority of the Federal Reserve's enhanced prudential requirements have been applied to all firms based on a simple asset measures. In the recent enactment of the regulatory relief legislation in May, Congress has now directed the Federal Reserve to tailor its requirements to the riskiness of the institutions that it supervises. With respect to regional banks, the Act first presumes that all firms with less than $250 billion in total consolidated assets are no longer covered by enhanced prudential requirements, and to apply them, the Federal Reserve must affirmatively demonstrate that the requirements are appropriate to prevent risks to the financial stability or to promote safety and soundness, and there have been no such risks currently identified for such firms. Second, the Act requires that the application of any enhanced prudential requirement to a firm with at least $100 billion in total consolidated assets must take into account a statutory multi-part conjunctive test. Third, Congress has required separate analyses for assessing the application of each enhanced prudential requirement. And finally, as the Federal Reserve proceeds to implement the Act, the substantive requirements of each of the enhanced prudential standards should also be revisited, re-examined, and tailored to ensure that the substance of each requirement is appropriate based on the risk posed by the subject firm. With respect to the application of enhanced prudential requirements to international banking organizations, since the passage of the International Banking Act in 1978, the regulation of international banks operating in the U.S. has been guided by a non-discrimination principle of, quote, national treatment and equality of competitive opportunity. Congress's commitment to national treatment was reaffirmed in Dodd-Frank. The implementation of enhanced prudential requirements has not always lived up to Congress's mandate of national treatment, and most notably through the implementation of an intermediate holding company requirement on firms with more than $50 billion in U.S. non-branch assets, and a variety of prescriptive governance, risk management, capital, liquidity, stress testing, and resolution planning requirements on the U.S. operations of international banks. The U.S. ring fencing requirements and reactive foreign ring fencing requirements cause a net increase in capital costs on international firms and U.S. firms operating abroad as countries apply standalone capital and liquidity requirements. This may have the perverse effect of making banks with cross-border activities less safe, because if a crisis in one geography burns through the firm's local pre-positioned resources, the firm may be precluded from using its resources located elsewhere to bolster the part of its operations under stress. There are a number of actions that the federal banking agencies should take to reintroduce national treatment into their regulation of the U.S. operations of international banks. First, the agencies should better account for the global resources of international firms when calibrating capital, liquidity, and stress testing requirements applied to the U.S. operations of these firms. Second, consonant with the June 2017 Treasury Report recommendations, the requirements applicable to the U.S. operations of international banks should be commensurate with the risks posed by their U.S. footprints. Finally, the current CCAR framework disadvantages international firms whose U.S. operations are primarily capital markets in nature and does not take into account the benefits of global diversification that exist for these international banks. Thank you, and I look forward to your questions.
Thank you, Mr. Norica. Appreciate your testimony today and all of the gentlemen here that are on our panel today. With that, we'll begin the questioning. I'll recognize myself for 5 minutes. I guess, Mr. Norica, we can start with you. With regards to implementing the Senate Bill 2155, do you see any ambiguity in the way that the $250 billion threshold was set?
Could you repeat the?
Yeah, did you see any ambiguity in the way that the $250 billion threshold was set, or is the statute pretty clear?
I think this, yeah, no, thank you.
Because you were talking about this in your statement here just now, and talking about you know, concerns and how that should be done, this should be done. Have you seen any concerns at this point with not being done?
Look, I think the statute is clear. The statute it presumes that these banks are out unless a determination is made both that there's a risk to financial stability of the United States or safety and soundness of the institution, and a multi-part statutory test is applied to each prudential standard to reapply to those banks. Now, I think, you know, we heard from the chairman of the Federal Reserve today in his testimony in an exchange with Senator Warner that they're working on this, and I think the effort is to urge the Federal Reserve to apply the statute as it's written, to, I think, immediately lift the enhanced prudential requirements on these banks until and unless they can empirically demonstrate that there is a need for each of the prudential requirements to apply to each of the institutions in this asset range.
Well, and I know that their comment period on this is just closed, and I'm sure they're listening. So has anybody got a comment they would like to make to the Fed to say, hey, we suggest this? Nobody has a comment to make to the Fed today? Really? Okay. I have a lot of them, but we'll stop there. With regards to Dr. Holtz-Eakin, you were talking about the stress tests and the importance of it, and I think you made a comment, something to the effect that it was, you don't think it's quite as good as it could be because it doesn't quite accurately measure the stress that banks are under. Can you elaborate a little bit on that? I would agree with you probably to a point. I mean, you can't, it's difficult to sort of guess what kind of stress can come, where it can come from, and all of the different variables, so who knows what's going to happen. But what would you see as some extra things that the Fed could do, or things perhaps that we could do to enable this to be a better situation?
Yeah, so I think there are really two areas. The first is the transparency and the public nature of the information revealed by the stress tests. If you think back to the first stress tests when they were done, the original plan was not to make the results public. And markets were in turmoil, and there was an enormous amount of fear and uncertainty. And when they decided to actually reveal those stress tests, it allowed market participants to identify healthier versus less healthy institutions pretty clearly. It allowed them to price those risks more effectively. It allowed them to bring market discipline to the operation of those banks. It's important that that continue going forward. I'm concerned, my comment to the Fed, about this plan to simply move away from having standalone stress tests, put everything into a CCAR process that doesn't look terribly transparent to me. I think that's giving up the opportunity to have market discipline as a complement to good regulation, and you need both. So that's sort of point number one. The second point is, I'm not a big fan of a single scenario stress test, right? So stress tests are done by lots of institutions for their own purposes, and they involve multiple kinds of scenarios to test genuinely their exposure to different kinds of downturns, different kinds of commodity price fluctuations, different kinds of housing market impacts. I would encourage the Fed to think more about bringing that kind of a regime into play.
Well, along that line, Governor Turiel, in my comments, I indicated that he made the comment that, stress testing programs should move into the normal examination cycle. And to me, I think that's where it needs to go. I don't know that the banks need to be filling out forms to have the regulators, see if they've guessed right on whether this is actually going to work. To me, the regulators should have a set of scenarios that they believe could happen. They go into a bank and they apply those scenarios to the business model and the actual bank numbers and see if it works. Is that something that makes sense?
I wholeheartedly concur. I think that's exactly the right way to use them and reveal those results. And that would be a good way to do prudential regulation. In the end, you want good safety and soundness regulation, and stress tests can be an important part of that.
My time has almost expired. With that, we will yield back the balance of time, and we'll go to the distinguished gentleman from Georgia, Mr. Scott's recognized for 5 minutes.
Thank you very much, Mr. Chairman. Mr. Bear, let me start with you. I want to ask your thoughts, ask you for your thoughts on stress tests, because as I mentioned earlier in my opening remarks, my bill with Mr. Zeldin makes structural changes to the stress test regime. In this way, our bill made such structural changes as saying the Fed couldn't fail a bank for their qualitative portion of their test, and we also eliminated the adverse scenario from the test requirements, among other things. But recently, from the Fed, as we all saw for the first time, handed out a passing grade when a passing grade wasn't deserved. The Fed referred to this as, quote, a conditional non-objection. It's interesting to know what that means. But I also viewed the amendments we made in my bill with Mrs. Zeldin as a way to reduce the burden without fully gutting these critical, important tests. But I viewed these recent actions from the Fed as a way to smooth out our markets' negative and often overly harsh reaction to the news of a bank receiving a federal grade. So, Mr. Bear, let me ask you this first part. What sort of reforms do you think are more important?
Sure. I mean, I would, thank you, Congressman. I would agree with you that the qualitative portion of CCAR should be part of the regular examination process, just the way they examine anything else, from credit underwriting to the markets businesses. Mm-hmm. The adverse scenario has not proven useful because it simply never binds and has just become an exercise that does not have a lot of benefit and is probably not as robust as some of the scenarios that Dr. Holtz-Eakin was talking about that the bank itself runs. With respect to the results and, pass or fail, I mean, I think where we need to get is where we have confidence that those results are actually meaningful and where the Fed can be comfortable saying there's really no reason to give an exception. Right now, and I think you've already heard it, we're in a mono scenario, mono model world where you have extreme stresses in certain areas and little stresses in others. That's not necessarily the result that's going to, or the process that's going to make the bank safest. Banks should not just be testing for, and I assure you they do not, very high increases in unemployment. They should be looking at what happens if there's a problem with foreign debt, something in China, something in Russia, a European issue, hyperinflation, deflation. So, banks that really are managing their risks, they look at all those different scenarios and then they make a judgment about, what their capital needs are. And so, we support the notion of the Fed running multiple scenarios, perhaps averaging them over time, suppressing the volatility.
Very good. Now, Dr. Holtz-Eakin, I hope I pronounced your name correct.
Exactly right, sir.
Thank you. You made some interesting comments in your testimony. First of all, you said that competition in the banking system is getting less. You said there are fewer and fewer banks. You said there are fewer and fewer checking accounts at these banks. You also said systemic risk regulation is now questionable. And then you said this. You said we need more stress testing and not less. Now, we got 5 distinguished gentlemen there. How many of you agree with Mr. Eakin that we need more stress testing, not less? All right, we got 2 out of 3. Tell me, give me, those of you, one of you who disagree, tell me why. Why do you think, now Mr. Eakin has said why we need more. One of you that raised your hand said we need less. Tell me why you disagree. Yeah, Mr. Farmer?
Yeah, I'll start. Let me just say that the issue is not the stress test per se, because the stress test process is a useful process. The issue is parts of the process that have proven to be not transparent, whether it's the models, as Mr. Baer has referred to, or the economic scenarios that Mr. Holtz-Eakin has referred to. So the improvements that we believe are necessary are focused on the transparency of both of those components of the stress test. So it may involve more scenarios as they've discussed, but I think it's the quality of the scenarios and the understanding of what is inside the model of the Federal Reserve versus the real experience of the institution itself, and then the quality of the actual economic scenarios. Are they extreme? Are they plausibly extreme? And when do the firms experience that information for purposes of their capital planning in order to reduce the volatility that's been mentioned?
All right, very good. Thank you, Mr. Chairman.
Thank you. The gentleman yields back. With that, we go to the ranking, or the Vice Chairman of the committee, Mr. Rothfuss. Gentleman from Pennsylvania is recognized for 5 minutes.
Thank you, Mr. Chairman. Mr. Baer, as you know, Basel III takes a fairly punitive approach to mortgage servicing rights compared to other intangible assets. This is particularly challenging for U.S. banks since our mortgage market relies on securitization, while banks in other jurisdictions tend to follow the originate and hold model. Can you describe how Basel III's approach to mortgage servicing rights affects U.S. banks?
Sure. Thank you, Congressman. Yeah, I mean, clearly there was a very large change made post-crisis to mortgage servicing rights. The level at which a capital deduction occurred, the threshold was much lower, and then the capital deduction, I think, rose from 100% to 250%. So it's a substantial penalty. It's also interesting that that came out of the Basel Committee, where really it's the United States. This is really a uniquely U.S. issue. So because we have a large securitization market, and I think it's fair to say that most countries around the world don't really have this issue as much. So that may not have been the best place to have it debated. I mean, it is fair to say that during the crisis, mortgage servicing rights did not become a readily saleable asset. So clearly there should be some restrictions on their ability to count towards capital. But I think it's a very good question whether the post-crisis reaction that came out of Basel was too extreme. And yeah, I think it would be a very good idea to recalibrate that. I think almost certainly downward to give more credit for it. Certainly not as much credit as common equity, but more. I think it's now 5 times the capital deduction for residential loans.
Can you maybe offer some insights on how capital rules applicable to mortgage servicing rights affect consumers?
Oh, sure. I mean, it affects consumers in 2 ways. I mean, one, it increases the cost of the servicing, but also what you've seen post-crisis as a result of the very high capital charge is that a lot of this business has migrated away from regulated banks to non-bank servicers. I think there was a time when that was considered to be a good thing. I think experience has taught us that consumers are probably better off if that's at a regulated financial institution with a lot of other relationships with that customer and a lot of incentives to do right by that customer.
Mr. Fromer, over the last decade, the federal banking agencies have built a complex regulatory regime with wide-ranging consequences for regulated institutions and the broader economy. While our committee has led the way on historic regulatory reform, we should all recognize that there is always an opportunity to build a stronger and more efficient regulatory system. In order to do that, we need an honest and thorough accounting of the rules in place today. In a speech earlier this year, Vice Chairman Quarles said the following, quote, "Now is an eminently natural and expected time to step back and assess past regulatory efforts. It is our responsibility to ensure that they are working as intended, and given the breadth and complexity of this new body of regulation, it is inevitable that we will be able to improve them, especially with the benefit of experience and hindsight." Do you agree that the Fed should undertake a holistic review of our regulatory regime, and if so, why would this be important?
Thank you for the question. First of all, I would wholeheartedly agree with that statement, and I believe it's a statement that's at least conceptually shared, not only here but in amongst regulators outside of the U.S. And that is to say, after you have a decade of experience and data, not only amongst the regulators but the firms themselves, that the responsible thing to do here is to take a holistic approach. As a perfect example of why you need to do that, we have something called the GSIB surcharge that applies only to the foreign institutions. That GSIB surcharge was put in place for the purposes of putting capital into the system in the event that there's a heightened risk of default or failure of a large firm and the impact that could have, the social costs that could have. But it was put in place at a time when a series of other improvements had not been implemented. Those improvements have been implemented, and as a consequence, the surcharge is to some degree redundant of the improvements that have been made. So that is an example of the kinds of things that I think the regulators need to take a broad look at in the context of the framework.
Mr. Noriega, in your testimony, you wrote that regulators should be transparent in the rulemaking and supervisory process and not become overly reliant on unofficial rulemaking through guidance. Of course, this backdoor approach to regulation was all too common in the previous administration. You recently finished a stint as the acting controller of the currency. Have you seen a shift in the attitudes and actions of regulators in recent months on this topic?
Well, I have, Congressman, and I think it's a welcome change, and I think we're, starting to see some of this reviewed by Congress through the Congressional Review Act, such as we saw with the indirect auto lending guidance. And I think there's an effort underway at each of the banking agencies to catalog their so-called guidance and see what needs to be put out for notice and comment, and then also what may be subject to congressional review as well. So I think it's a welcome guidance. I think rules beget more rules, which beget more rules in how they're implemented, and guidance obviously is useful up to a point, but it has to remain guidance. And when it becomes binding effect, then there are certain legal protections that are there for those that are regulated, and that has to be, the government has to be mindful of that.
My time has expired. I yield back. Thank you.
Gentleman's time has expired, but that goes, the gentleman from Texas is recognized for 5 minutes. Mr. Green.
Thank you, Mr. Chairman. Thank the witnesses for appearing as well. I remember when we were talking about long-term capital. Anybody remember that name, long-term capital? Okay, thank you. And we were talking about events and how things just couldn't happen. But before there was a long-term capital, we had people who were very skeptical about regulations. And nobody anticipated that long-term capital would occur, but it did. I remember when the banks would not, N-O-T, would not lend to each other. And I remember why we had to resort to Dodd-Frank. Dodd-Frank was necessary, and in my opinion, it has served us well. I think the living wills, the stress tests, are important for a multiplicity of reasons, I might add. But we have two persons who've indicated that they think that we should have more stress tests, and didn't get a chance to hear your responses as to why. So let me start with the first person who would like to respond. Which of you will that be, please?
I'll go. Yeah, I mean, and it's a very broad question. I mean, I think for firms that are subject to stress testing, and I think that should include large, complex firms, those that have a variety of businesses, perhaps internationally, you're always going to be better off running more stress scenarios rather than fewer. You don't want them only preparing for one type of impact as opposed to a variety. That's not to say, though, that for every firm, stress testing is appropriate. And I believe Congress got it quite right in 2155 when it moved from annual to periodic with respect to regional firms. Those are generally firms that have a pretty homogeneous book of mortgage loans, C&I loans, generally not any international exposure, probably have a more complex liability structure. So, I mean, I think it really varies depending on the bank. But once you're saying, yes, stress testing is appropriate for this bank, I'm very worried about the current regime where you have a mono-model, mono-scenario approach to determining the capital adequacy of that bank.
Mr. Stanley, I think you were among the two.
Yeah, I think what's going on here is that I agree conceptually with Dr. Holtz-Eakin and Mr. Baer that there's a wide variety of types of stresses and stress scenarios that could impact a bank, and regulators have to be, both regulators and banks have to be creative and aggressive in seeking out what might be unforecast risks or risks that are difficult to forecast that might harm the bank. But so you have to test a greater range of scenarios. But I would just point out that this goes, in my view, completely opposite to this claim by industry that we can't have volatility in stress testing results, and stress testing impacts and stress tests can't change from year to year. The very fact that markets change so often that you have to check multiple scenarios, to me means that there should be an unpredictable element in stress tests. They should change. And if you had a stress test that was totally predictable, it wouldn't really be stressful and it wouldn't really be a test. So
I think that I see someone who'd like to respond to your response, so I'll yield to you.
Well, I mean,
give your name, if you would. Is it Mr. Baer?
Yes. I mean,
Thank you.
I think to the extent that markets are actually changing, banks' capital requirements should change. If all that's changing is the stress test that's chosen by the regulator, that really shouldn't be causing large changes in banks' capital position. It's important because banks have to make long-term business plans, 1, 2, 3, 5 years out. And if you don't know what the capital charge is going to be for that business, it's very difficult to do that, and that does not help consumers or businesses. Again, if there's a real change in the bank's risk, yes, it's to the upside, the bank's capital requirements should go up. If it's to the downside, it should go down. And this doesn't necessarily mean, I would say to Dr. Stanley, lower capital requirements. To the extent that you're averaging them, either averaging a variety of scenarios or averaging the results over a couple of years of whatever that stress test scenario is, that would still suppress volatility, wouldn't necessarily
I
mean
think
lower
Mr.
capital.
Stanley would like to have a final retort, so I'm going to allow this debate to continue for this last round. Mr. Stanley.
Well, I have very little time, but I guess I'd just point out that in terms of capital planning and long-term planning, we actually don't want banks over-adjusting and trying to track the regulatory capital requirements. That element of unpredictability, I think, could be important precisely so that banks don't take excessive account of regulatory requirements in their future planning and instead look more at the business environment.
Mr. Chairman, if I may, Ranking Member Clay has asked that I offer some materials for the record with unanimous consent.
Without objection.
The Center for American Progress has a rather lengthy document and letter to be submitted. Better Markets, similarly situated. The Americans for Financial Reform, I ask that if there are no objections, that all be submitted into the record.
Without objection.
Thank you.
Gentleman's time has expired. Then we go to the gentleman from Oklahoma. Mr. Lucas is recognized for 5 minutes.
Thank you, Mr. Chairman, and I'd like to revisit a couple of issues with my colleagues here. But first, I always remind folks that coming from a capital-starved region, the oil and gas industry, agriculture, Main Street in rural Oklahoma, capital is always a challenge for us. By the same token, I acknowledge to you that I come from a long line of debtors, so I have a certain perspective from that perspective. Let's visit. Mr. Barrett, I've heard my constituents in the wake of S2155 say that they are confused about legislative intent when it comes to stress testing. And some of my banks, most of which are very small and are well under the $100 billion threshold, believe that 2155 was meant to do away with all stress tests for banks under those numbers, not just the test called for in Dodd-Frank. I realize you don't speak for FDIC, but is this a view that's widely shared among the industry?
Yeah, I think, Congressman, that if you're under that threshold, the assumption and certainly the way I would read the statute is that that's the end of having to do these types of stress tests. And I'd say we're actually quite concerned that regulators these days are very fond of what we call horizontal reviews, which we sometimes call examination as management consulting, where they will look at a variety of banks and come in and say, well, you know what, we don't like your practices. We want you to do what some other bank's doing. So we are very concerned that these same requirements that have been ended by 2155 will actually come back in through the examination process. And I really think that's something for this committee to keep an eye on.
Yeah, that was my next question, was how we clarify the situation so that the intent behind 2155 is obvious to everyone.
Yeah, I mean, again, Congressman, I think it's a real concern. I mean, we have could have a whole separate hearing on the examination as opposed to the regulatory process, because I think particularly for smaller banks, a lot of this isn't about stress testing or GSIB surcharges or any of that. It's really about a fundamental shift post-crisis away from examination focusing on safety and soundness issues that are material to the health of the firm, and more towards more minor criticisms and consulting and horizontal reviews. So I do think it's going to be a long process, but I hope that the new leadership of the agencies can refocus the exam teams on matters that are material to the financial institution and not just wanting them to do it a different way.
So you don't disagree when the bankers say they read what they read, which is why I read the bill. It sounds like the way you read the bill. Yeah, it's a matter of making sure everyone understands.
I mean, I think Mr. Noreka alluded to guidance where for years now banking agencies have been issuing guidance, and they say it's only guidance, but every banker you talk to, every compliance department says, no, we treat that as a binding regulation in every case because that's the way the examiners treat it. So it's a cultural thing. I think it's going to be difficult to resolve, but it's an important issue.
Mr. Noreka, let's touch on that subject of the issue of mortgage servicing rights and their treatments under the capital rules. I have a couple of constituent institutions in Oklahoma that have been very successful in servicing things like FHA loans. There are other institutions across the country that are very successful in dealing with VA and USDA loans. And they are very concerned, as we've discussed earlier, that under the Basel III cap, combining with the risk of these assets hinders their ability to engage in the activity. And they tell me that they are seeing literally the business being driven to non-bank lendings where the regulation is lighter. Could you touch on that for just a moment? Is this a legitimate concern by my constituents?
Yes, and it's something I faced at the OCC, and we put out a proposed rule that hasn't yet been finalized. But certainly the capital charges for servicing rights are overly punitive. It disproportionately impacts regional community banks and reduces the availability of loans in our communities. Holding mortgage servicing rights is often part of a sound strategy for banks that originate and sell loans while retaining the right to service these loans. The practice permits banks to make loans in their community and develop stronger customer relationships while appropriately managing risks to their balance sheets. As I mentioned, when I was at the OCC, we put out a capital rule to streamline and loosen the punitive requirements on these requirements in I believe, September 2017. I think the time has come for the agencies to finalize that rule with respect to mortgage servicing rights and take away some of the punitive effect that comes to holding these assets.
Thank you, sir. Yield back, Mr. Chairman.
Gentleman yields back. With that, we go to the distinguished gentleman from Kentucky, Mr. Barr, the chairman of the Monetary Policy Committee, is recognized for 5 minutes.
Thank you, Mr. Chairman. I'll start with Dr. Holtz-Eakin. Question about the legislation that was recently signed into law, the Economic Growth, Regulatory Reduction, and Consumer Protection Act. What do you believe will be some of the most pronounced impacts on bank lending now that that law has been signed?
I think the most pronounced impacts are going to be in the relatively small loans, you know, $50,000, $100,000, $200,000 to small businesses in those areas. We know there's been a big geographic dispersion in the quality of the economic recovery. It looks a lot like the geographic dispersion in the access to credit, and so I think that's an important economic benefit.
Can you elaborate a little bit more on your testimony about market discipline as an additional factor in strengthening the financial system in addition to capital requirements?
There is nothing better than capital for honing incentives, right? The thought of losing your own money is a powerful motivator. And if you have investors who are looking at institutions carefully and correctly trying to price the risks that those institutions face, that's a tremendous source of discipline to the operation of those institutions. So wherever possible, it's useful to try to bring that into the process. And that's one of the reasons I at least think that the stress tests are so valuable. They provide information to market participants about how firms react in different situations. That's useful for pricing.
Is there a lack of transparency anywhere in the law right now that could be corrected in terms of transmitting greater level of information to consumers?
I just echo a lot of the things that Mr. Barris said about the current stress testing regime not having sufficient robustness to convey all the real risks that these institutions will face and can weather or not weather, and that's what you want to know.
Mr. Noriega, thank you for your service at the OCC, and let me just ask you now, given your background in both the private sector and the public sector, your thoughts about the role and importance of regional banks in the traditional lending model, and how does overregulation contribute to curtailing lending and economic growth?
Well, thank you, Representative Barr. Look, failing to properly tailor the enhanced prudential requirements with respect to regional banks or all banks will continue to increase the price and limit the availability of credit in the United States and ultimately stifle economic growth. Poorly tailored requirements also hurt access to credit, usually for those at the margin, those in underserved communities, which are often served by regional banks. Poorly calibrated requirements also unintentionally incentivize unnatural and risky behavior, and they make the market less safe.
Can I jump in really quickly? The thrust of your testimony was that the $50 billion asset threshold was an arbitrary threshold, and that the new regime is preferred approach based on these multi-factor tests.
Yes.
The presumption is that if an institution has assets less than $250 billion, it doesn't warrant that enhanced prudential supervision, but it does give discretion above $100 billion for that for the application of those enhanced supervisory rules. What's magic about the $250 billion threshold? Is there an argument to be made that that threshold should go up as long as the regulators have the discretion to apply a similar multi-factor test to institutions between, say, 250 or 500 billion, or for that matter, any institution that's not categorized as a GSIB?
Sure, that's a very good question. Look, I think the way the world is divided now in light of the regulatory relief legislation is that everything under 250 billion is presumed to be out, and everything under 100 billion is absolutely out by statute. Above 250 billion, Congress now has directed the Federal Reserve to apply its enhanced prudential standards based on this multi-part test. One of those factors is asset size, but the other factors are not asset size. And so even for the banks above $250 billion, the Federal Reserve has to go back and they have to look at each of their, and it says any prudential standard, so it's for each one, they have to look at them and they have to look at those factors with respect to the individual institution. And I think this sort of dovetails nicely with what we're hearing out of the new leadership of the Federal Reserve as far as tailoring goes. Congress has provided a roadmap for tailoring.
I have more questions, but my time has expired. Thank you.
Thank you.
Gentleman's time has expired. With that, go to Mr. Tipton. He's from Colorado. He's recognized for 5 minutes.
Thank you, Mr. Chairman. Thank the panel for taking time to be able to be here. And Mr. Noriega, maybe like to be able to go back a little bit more in terms of some of the question that Mr. Rothfuss had brought up in regards to, are we actually seeing the needle starting to move after 2155's being signed into law with the regulators? Some of the comments that I've had from some of my local banks is when you were just talking about some of the tailoring end of it. You know, they said they really haven't seen any real impact. It's business as usual. So could you maybe drill down a little bit more on where you're seeing that movement starting to go?
Sure, and look, I'm on the outside looking in now. I was recently on the inside looking out. I don't disagree with your statement. I think that Congress has provided a fairly clear guidance to the agencies. I think that the agencies did take immediate steps for the banks below $100 billion to inform them of certain changes. Maybe that hasn't filtered out entirely, but I think that whatever those are, they should, be in constant contact with the regulator to work out those issues, because what Congress did was fairly clear. I think the real issue sort of immediately facing the agencies are with the below $250 billion, this presumption that they're out, unless there's a finding made of that there's a threat to financial stability or safety and soundness, and the application of a multi-part test. And then above $250 billion, there is the application of the statutory multi-part test that now is directed by statute. And I think that's one we haven't yet seen the agencies come out and talk about, and hopefully we will soon. But, I do have an appreciation for the way things work in the public sector as opposed to the private sector. I suppose 2 months in the private sector, in the public sector, isn't quite as fast as perhaps I would like, or you would like, but I'm sure that they're working on it diligently, and I think hearings like this help give valuable input on helping them to come to a formulation of how they're going to deal with these different groups of banks.
Right, and I think Mr. Barr's comments in terms of setting arbitrary thresholds, how that impacts. Do you have some recommendations, maybe specifically, rather than just having arbitrary thresholds? I know they're working on it, but is there something more that Congress could be doing?
Well, look, I think you're doing exactly the right thing by holding hearings like this, and I think you can step in with targeted legislative actions if the agencies go in the wrong direction or read the law the wrong way, hold their feet to the fire, and that's exactly what you should be doing. I think, you know, right now, the goal is for the agencies, and with congressional direction, to go re-examine everything they did before. And so that not only is the scope, but also the substance as well. I mean, I think you have to also look at each of the requirements and see whether they're narrowly tailored or whether it's a broad brush approach to applying something to one of the largest banks than being falling downhill, if you will, as I think Senator Corker once told me, toward the Main Street banks and having an overly punitive effect, which has ramifications for the economy.
Right. Mr. Baer, would you maybe like to comment a little bit on this? I thought it was interesting you were making the comment in regards to some of the horizontal type of examinations that are going on. And I came from the private sector, and we were constantly doing a review in business almost every day, had the flexibility, the nimbleness to be able to make some changes if necessary, to be able to do it. Would you maybe address some of that regulatory process?
Congressman, it's actually, I think, quite interesting from a bank regulatory policy perspective that, you know, clearly, and I think they would agree, in recent years, the Fed and the OCC are going in opposite directions in terms of how they examine. The OCC is reemphasizing the importance of the examiner in charge and having a resident team that knows and understands that bank. The Federal Reserve is moving towards a more centralized approach with, you know, cross-reserve bank, cross-functional teams, and a lot of the folks in Washington. I could actually make a good argument for or against either approach. I think either could work, either could fail. But I do think the risk of the latter approach is that you get to having the cross-functional team as sort of judge and jury, where, you know, they're looking at multiple banks and they're picking the one they like the best. I've heard this from multiple firms that, you know, they were told, well, yes, on the liquidity front, you're in compliance with the LCR, you passed CLAR, you know, your own, you know, work is pretty good, but we just completed a horizontal review and we like what somebody else is doing better. Now, will you give you access to that? No, we will not. That's confidential supervisory information, but we'd like you to up this or change this. And I think that's very unfair to the banks. And also, I just think it's a bad idea in that there's real benefits. I mean, ultimately, banks compete on their ability to manage risk. And if you're going to have all banks manage risk the same way, obviously that's something of an overstatement. But to the extent that you're pushing banks to measure risk the same way and manage it the same way, that's not a great thing.
Great. Thank you. My time's expired, Mr. Chairman.
Gentleman's time has expired. With that, we have the ranking member has returned. And with that, we recognize him for 5 minutes worth of questions. Mr. Clay.
Thank you, Mr. Chairman. And Dr. Stanley, regulators under the Trump administration have said that since it has been a decade since the financial crisis, and it is time to review and revisit all of the post-crisis financial rules to seek improvements. What is your early assessment of their proposals? Are there proposed modifications to post-crisis reforms one-sided with a focus on deregulating the financial industry?
Well, you answered the question for me. They absolutely are one-sided, and we have no problem with reviewing. We do believe that it's entirely appropriate to review our regulatory framework, but this is a review that seems exclusively focused on weakening the regulations that came out of the financial crisis. And in fact, in several cases, we had proposed rules that were ready to go that would have strengthened regulation of bank bonuses, regulation of commodity activities at banks, and these rules were just dropped as though they never existed because they didn't go in that deregulatory direction.
Yeah, and do you think lessons from the financial crisis have faded in the minds of some policymakers? I know that when I look at the housing market, just like African American borrowers were steered into high-priced loans for no reason other than the complexion of their skin, that now we have reverted back to that there's still a disproportionate number of people who are applying for 30-year mortgages are being denied. Do you think those memories have faded already after 10 years?
Well, I think that that memories may have faded in Washington, D.C. I don't think that memories have faded outside of Washington, D.C. Middle class wealth is still significantly lower than it was before the financial crisis. A lot of the impacts of financial crisis in terms of loss of housing, in terms of increases in poverty, have not really, are still with us outside of Washington, D.C. So,
yeah. Do you believe the Fed failed, as many of us do, at implementing and enforcing our consumer financial protections laws prior to the creation of the CFPB?
Well, I think it's very clear that the Fed failed. The Fed was warned, and the Fed did not take action on predatory subprime lending, on predatory lending that targeted minority communities. And in the case of the OCC, we had the OCC actively stepping in to preempt and reverse state laws that would have taken action against some of this predatory lending. So they were actually weighing in to expand predatory lending. So, and that's why it's been so important to create an independent consumer agency.
And they knew the countrywides and the other predators were out there preying on consumers, and they enhanced it and helped them. Unbelievable. Was it important to impose enhanced prudential standards on the nation's largest banks, as Dodd-Frank did, including requiring more capital, less leverage, and regular stress tests?
Well, absolutely. I mean, things went terribly wrong before the financial crisis. You had entities weeks before they failed reporting that they were perfectly fine and they exceeded regulatory capital requirements that existed before the before 2008, weeks before they failed. So the prudential requirements before 2008 were just manifestly inadequate and permitted all kinds of abuses and really had to be reformed.
Do you support the Volcker Rules prohibition on proprietary trading so that banks that benefit from the federal safety net do not gamble with deposits?
Yes, we do. And you know, a lot of people say that the Volcker Rule proprietary trading ban is somehow disconnected to the crisis. But the truth is that banks lost hundreds of billions of dollars from assets held in their trading books, from trading inventories. They lost well over $100 billion in 2008, and that was a major contributor to the financial crisis. And Volcker, I think, could be improved in a variety of ways, but it takes that on, and that's a critical issue.
And I thank you for your responses, and Mr. Chairman, my time is up.
Gentleman's time is up. With that, we have a second round. Mr. Barr would like to ask a few additional questions. He's recognized for 5 minutes.
Thank you, and I appreciate the second round, Mr. Chairman. And to Mr. Fromer and Mr. Baer, questions about this Mono model of stress testing, and I think, Mr. Baer, you specifically touched on this. I'm interested in this because I've heard Randy Quarles talk about this as a risk for regulators to focus on a Mono model testing, and I'm curious to know your thoughts on how the Fed and other regulators can best avoid a Mono model stress testing regime, and how can we avoid a situation where banks and participants in the financial services sector are moving in the same direction, creating and concentrating risk as opposed to allowing an organic diversification of risk that is fueled by a diversity of stress testing scenarios.
Sure. I think one potential answer is to provide full transparency around the model, which would also allow for notice and comment from a whole wide range of folks, all on this panel, about whether that's a good model or not. It would allow back testing and real consideration of it. I know there have been concerns expressed by some that would let the banks know the test. But I mean, I think of an analogy: if the EPA decided to regulate pollution controls and said, we're not going to tell you the regulation, we're just going to run a secret model, and at the end of the year, we're going to tell you whether you passed or not, and if you didn't pass, then you can't operate next year. No one would think that that's a fair system. You know, when the government has rules, we as citizens have the right to know the rules. Now, if the concern is so great, though, that we aren't allowed to know the test, then I think it's a perfectly good option to allow bank models to be used as part of the stress test. Those models are not made up. They're rigorously back-tested, and the Federal Reserve now reviews and approves every one of those models. So if they can't provide transparency, then I think there's a ready alternative.
Right. So, I mean, I think it's purposeful from the standpoint of financial stability. It's also a due process issue, of course. Mr. Frommer, let me just shift gears, actually, to another question. In recent testimony before this committee, Randy Quarles, Vice Chairman of Supervision, testified that because of the improvement in the resolvability of firms realized over the past few years through the living will process, it's appropriate now to reassess the GSIB surcharge calculation. The GSIB surcharge applied to U.S. banks is nearly double that of the international standard, placing our institutions at a competitive disadvantage in the global marketplace. But now we hear about this stress capital buffer that effectively doubles down on what has already been acknowledged to be a miscalibrated requirement by enshrining the GSIB surcharge in this new rule. I know you share the same concern. Can you elaborate on why that is a problem from the standpoint of international competitiveness?
Sure. And first of all, the GSIB surcharge, as I stated earlier, was put in place to deal with the systemic risk, the potential for default, the impact of default in the system. And, you know, as Governor Quarles and others have indicated, there are a number of other steps that took place after implementation of the GSIB surcharge or the establishment, which to some degree have made the GSIB surcharge redundant. And that's why we believe it's necessary, it's crucial, in fact, to go back and look at it. The problem with the GSIB surcharges with respect to international competitiveness has to do with the fact that in the United States, the regulators applied a higher standard known as Method 2. And Method 2 is essentially a higher charge for these U.S. GSIBs. You know, in our view, that actually creates a built-in disadvantage for U.S. institutions vis-a-vis their foreign peers. So, first of all, if you feel like if you believe that the system has improved through a variety of different improvements, whether it's TLAC or clearing and margin or living wills, you should go back and look at the GSIB surcharge. And then specifically, you need to look at Method 2 because of the built-in disadvantages that it provides for the U.S. GSIBs versus their foreign peers. And it's amplified, as I think you are getting to, by the fact that the GSIB surcharge has now been imported into two other schemes, one of which is the supplementary leverage ratio for the largest banks, and the second is the stress capital buffer proposal.
And so I think we all should be interested in the competitiveness of U.S. institutions relative to our foreign competitors, and yet at the same time, to Mr. Norieca's testimony, we also know that foreign banks are an indispensable conduit for foreign investment in the United States, which is a source of a lot of high-paying jobs. Frankly, higher foreign direct investment is responsible for higher-paying jobs in many cases than domestically produced jobs. My question to you is, according to a 2016 Federal Reserve report, a substantial percentage of loans provided in the my time may have expired already. Well, I didn't get to that question, but we'll continue the discussion, Mr. Noriega, at another time. Thanks.
Happy to.
Yep.
Gentleman from Kentucky is full of questions, so we can be here till midnight, and he will still be asking questions, but good questions. The ranking member, Mr. Clay, has got some second questions as well. He's recognized for 5 minutes.
Thank you, Mr. Chairman. And Mr. Noriega, during your tenure as acting comptroller of the currency, you moved to weaken the agency's examination policies for the Community Reinvestment Act with respect to discriminatory or other illegal credit practices. Can you explain to the committee how this policy helps combat discriminatory lending?
Well, first of all, no, I didn't. Secondly, what I did do was we instituted guidance that put Community Reinvestment Act back in
I hope that's not an omen.
Hopefully it's not. For one or the other of us, right? Exactly. So what I did do is we instituted a policy so that basically community reinvestment is evaluated for community reinvestment purposes. So there had been a trend in the prior administration toward penalizing banks for things that had nothing to do with investment in their communities and the type of lending activities that they used to claim credit for their CRA exams. And so what we did is we went back to basics of the Community Reinvestment Act. So at the outset, each bank is reviewed, under the current rule at least, for its lending operations, its service activities, and its investment activities. And what we did is we said, with respect to the activities for which a bank claims lending credit, if those activities are done in a way that harms consumers, then that will be the basis for a downgrade. There has to be a logical nexus for the non-compliant, consumer-harming activities to affect the CRA rating. Because again, CRA, the whole purpose of it is to make sure banks are lending in their communities. We don't want to be overly punitive because then a bank might decide, hey, we have such big problems, we're not going to do anything. We're going to get our problems settled and not invest in the communities. I did not want that to happen. And what I worried about was that the so-called downgrades, which expanded more broadly than the activities that were used to claim credit, would actually act as a deterrent to investment in communities.
And thank you for that response, but I'm wondering, did you dig into the numbers to see that, okay, in economically disadvantaged parts of that service area, did they do 30-year mortgage? Did they extend 30-year mortgage? Did they do home improvement loan? Did they do small business loans? And did that data help you determine the grade?
Well, look, I think you can never decide something going forward. Obviously, afterwards, you have to look back and see how it did. And I think that's the general context of this entire hearing is looking back at things that may have been perfectly reasonably put in place at the time, but may have a deleterious effect or just the market changes over time. With respect to Community Reinvestment Act, look, I think the original purposes of the act were, again, clearly to get banks to not abandon their local communities, a very laudable effect. I think the worry was that a lot of other baggage was getting placed on that ultimately would deter that lending in communities. And that's what, frankly, concerned me the most and why I instituted that examination guidance was to, again, get back to the basics and encourage banks to lend in their community and not deter them from doing that.
Well, but think about the challenges that impact economically disparate communities. Economically disadvantaged communities. Those are the ones that need the financial stimulus the most.
Oh, I absolutely agree with you.
And so, I mean,
I
that's
absolutely.
what I always thought the CRA was.
Yeah. No, I absolutely agree with you, and I do somewhat worry CRA was getting hijacked as just another way to penalize banks for general things they did wrong to consumers. And I think there has to be that absolute laser focus of CRA on the underserved communities themselves and getting banks to invest in them, and that was why I did what I did.
And that's why we have the CFPB as to be the cop on the beat, I would think. Thank you. I yield back.
The gentleman's time has expired. With that, we have the gentleman from Georgia, Mr. Loudermilk, has returned, and he's recognized for 5 minutes.
Thank you, Mr. Chairman. And I would like to start off by yielding a portion of my time to my friend from Kentucky, Mr. Barr, so he can continue that very intriguing and interesting line of questioning that he was in.
You're not going to get me out of a question here, are you? You're gonna...
I want to thank my friend, and I'll be brief since I've already consumed too much time. But the follow-up to Mr. Noriega, just as the GSIB surcharge could put U.S. banks at a competitive disadvantage, what I was getting at in my question was that similarly, unfair treatment of U.S. subsidiaries of foreign banks could also be a problem from the standpoint of U.S. economic growth, because it could incentivize those foreign banks to decrease their U.S. operations and could lead to a withdrawal of foreign funds, many of which are contributing to foreign direct investment, which again is a source of a lot of jobs and economic growth. So the question is, from a competitive equity standpoint, how can we approach regulations to make sure that U.S. subsidiaries of foreign banks operate on a level playing field with their counterparts?
Sure, and that's the statutory directive. But I must say, you know, from my time in office, seeing these foreign banking organizations come talk to me, they were dramatically pulling out of the United States, especially with respect to the capital markets type activities that, you know, before the intermediate holding company requirement had been sort of the subject of functional regulation under the Gramm-Leach-Bliley Act, due to the Intermediate Holding Company Act, had been pulled into banking regulation and subject to these enhanced prudential standards. The cost of doing business apparently went through the roof and drove that capital outside the United States. And I think to the detriment of our country, as you're pointing out, in the sense of the markets are less liquid, the activities pushed out into less regulated spheres, and obviously there's the real world impact on people who may be employed or not employed anymore by these institutions.
And I better reclaim Mr. Loudermilk's time. Thank you, my friend.
All right. Thank you. And Mr. Noriega, well,
thank you.
We'll continue with you since we have you there. My question really is around the SIFI designation, and you know, under Dodd-Frank, specified between $100 and $250 billion in assets. Those financial institutions are entitled to complete relief from regulation as a SIFI institution after an 18-month transition period. My understanding is also that after that period, that the law gives the Fed the ability to restore the regulations if the bank becomes systematic risk. But under the current conditions, recent CCAR results and GSIB surcharge risk data shows that banks with less than $250 billion in assets do not present this type of risk. I, as well as others, think they should be exempt from all the regulations associated with being SIFI unless there is significant change to risk profile. My question is, do you agree that these banks do not currently pose that type of systemic risk?
I do, Congressman. I mean, certainly if those are the Fed's own findings with respect to systemic risk, I don't think there's any reason to wait to exempt them from the enhanced prudential standards while the Fed then goes and reviews how the standards need to be revised in light of the new law.
Okay, thank you. Mr. Baer, because of the short time that I have remaining, I understand that some of the biggest challenges of CCAR stress test, in addition to the sheer burden of these Dodd-Frank requirements, is the fact that the stress test models used by the Fed are relatively secret. In a 2016 GAO report, it showed that CCAR process is overly qualitative, offered too little communication for regulated banks, and that the scenarios were designed without appropriate analysis. Can you shed light on why that is such a problem for institutions such as yours?
Sure. It's difficult even to explain how complicated the CCAR process has become, what a data drain it is, what a resource drain. I mean, I think even, you know, for banks in the 100 to 250 billion who we expect no longer to be doing this, you know, it's probably dozens of people, maybe up to 50 to 100 at the bank doing this full time. At the larger institutions, it's hundreds of people doing this full time. It's a very intensive data exercise. And then, of course, as I got to earlier, you know, they really don't know a lot about the model that they're trying to manage to. I mean, you can try to reverse engineer some things, and we've actually tried to derive the implicit risk weights from what that model produces, and you can get some indications. But it's a very difficult process. Again, I mean, I do support stress testing, you know, for large, complex institutions that have, you know, really complex risks. But, you know, particularly for a $100 to $250 billion institution, you know, traditional supervision without that is, you know, unnecessary, I believe.
Thank you. With that, I yield back.
if you have some additional questions, gentlemen, you certainly recognize, because we got a little time here.
In other words, I'm the only one left, Mr. Chairman. Is that right?
Well, it's raining outside, and the game hasn't started yet tonight, so we're okay.
Well, I think after the last thunderclap, everybody ran. I hope they're not going 2 by 2 to a big wooden boat somewhere. Maybe we should. Well, then I do have. I'll also defer to Mr. Fromer to answer the same question, if you'd like.
Well, I think what I'll add to what Mr. Bear said was that, for banks of all sizes, it's a difficult process. It's a complex process. It is resource consumptive. But the other thing it is that it makes it extraordinarily difficult for the boards and the management of these institutions to go through this awful process of planning the deployment and the distribution of their capital. And to the extent that you have opacity in the models, and to the extent that you get scenarios presented to you in February for a process that is supposed to conclude and does conclude in June, and then you live with the results, for the next quarters and have no flexibility in terms of your further distribution of capital, even though there may be things going on in your firm or things going on in the economy, at large, which affect the operation of your firm, affect the plans that you made and your ability to dynamically change the nature of your business with those events. The process right now is very constraining, and in effect, it says, even though you've met your minimum requirements, even though your institution is safe and sound, you got all your minimum requirements in place, you as a board, you as a management are still restricted in terms of the way you can deploy and distribute your capital. And that's sort of an erosion of fiduciary responsibility that we think needs to be addressed as part of the overall review.
So does this inhibit your ability to properly serve your customers?
Inevitably, it does. I mean, if you've gone through a thoughtful planning process, as our institutions all do, and you're constrained by information that you do not have because you just don't have access to it. I mean, none of us could sit here and tell you what goes on with respect to these models and how the scenarios are actually put together, because it truly is opaque. So the degree that you can't make decisions about the operation of your institutions, it inevitably affects the kinds of services that you're going to provide to your customers and the pricing as well.
And Mr. Bear.
If I could just add, there's also a really important credit allocation component to this. Our research team went back and looked and derived sort of the implicit risk weights for CCAR compared to the standardized approach and then compared to the bank's own modeled approach through DFAST. And what they showed was that the implicit risk weights, that is the capital charge, were dramatically higher for certain asset classes, most notably small business, prime mortgage, and market making. It's actually about the same for C&I. But so implicit in this, though, is that it is driving banks in certain directions and driving all the banks in the same directions. And it's interesting, we then took the next step and said, well, can we see that in the actual data, in how banks behave? And what do you know if you look, and I think some of this is in my testimony, actually I know some of this is in my testimony, if you compare banks subject to CCAR versus banks not subject to CCAR and look at their behavior, you'll see the banks that are subject to the test are moving out of the asset classes that are most affected by the test.
Okay, thank you. Mr. Chairman, I don't have any further questions. I could be glad to yield to you or yield back.
We're already in our second round, so you got your second round of questions. If you're done, we'll move on.
I am done.
Gentleman yields back. Okay. I've just got one comment, which is, the reason for the stress test originally because of Dodd-Frank was because of systemically important institutions that could bring down the economy. And I think, we've talked about in the bill at 2155 that it set thresholds. And while I'm not a big fan of thresholds, I think anybody would recognize that a $250 billion bank, while it's a big bank, is not big enough to bring down the economy of the United States. So I think we have to remember why that part of Dodd-Frank is there and what kind of implications it could have and should have. And those banks now that are exempt under 250, I guess we'll watch the actions of the Fed, but I know the regulators, but they should not be considered systemically important to the point where they're going to be negatively impacted by overburdensome regulations of additional tests. One thing that we haven't talked about yet, we've discussed pretty thoroughly everything else is, and Mr. Bear, I think you brought this up, is CECL. Can you comment, and Mr. Frommer perhaps as well, with regards to the impact of CECL on capital accounts, and if you've seen any kind of impact at this point yet?
Certainly. Thank you, Congressman. I think it's a terrifically important issue, and I appreciate the opportunity. I mean, CECL began with a very good idea. The Financial Stability Board recommended to the FASB that they look at the accounting for reserves. The concern was that reserving could be procyclical. That is, in the midst of a crisis, banks are having to add reserves, and that means they're shrinking lending. A fundamental mistake, though, I think was made in projecting what the effect of this would be. The change was made from the incurred loss methodology, which basically said you set up your reserve when a loss is estimable and probable. That's been the standard for 40 years. The new requirement says that you have to set up a reserve at the time you make the loan for all projected losses over the life of the loan, even if the chances of those are small. Meanwhile, you cannot book any potential income from that loan over the course of its life. So that's a fairly significant change, but the idea was, okay, well, let's have them take the reserve at the beginning, and then when things go bad, they won't have to restrict and build a big reserve. The fundamental problem with that, though, is it presumed, and I think the analysis done by economists on it, presumed, as economists like to presume, perfect knowledge. So it presumed that everybody got it right at the start. What our team did, after hearing a lot of nervousness from the CFOs about this, is we actually went back and reran the 2007 to 2009 financial crisis. And we said, let's not presume perfect knowledge. Let's actually look at what the macro forecasts actually were at the time, extant in the economic community, and see what happened. And what happened was they didn't have perfect knowledge. And what happened is, as you got into 2008, that's when all the forecasts went bad, or assumed that there was going to be a very large recession. And so what would have happened if CECL had been in place is there would have been massive reserves taken. Not just reserves on the loans for which losses were already estimable and probable, but loans for a reserve for all loans, and particularly for loans to low and moderate income people. So what our review shows is if CECL had been in place, it would not have been countercyclical, it would not have built reserves in 06 and 07, it would have been profoundly procyclical, it would have meant massive bank reserves in 2008, which almost certainly would have dramatically heightened the recession. So, ours shouldn't be the last word on this. We're trying to encourage more research, not discourage more research, but it's certainly the gut sense of the folks in finance that we've talked to at the bank, so we think it's a terrifically important issue.
Anybody else want to comment on that? No? Okay. Basically, we're finished here. Would anybody like to have a closing comment? I can go down the line here. Anybody give everybody about a minute and a half to just make a couple closing comments on issues that came up that you would like to talk about that maybe weren't thoroughly discussed, or you reiterate one specific point. Mr. Frommer?
Thank you, Mr. Chairman. I think the point that I would make is that simply a reiteration of the view that there is an opportunity now and a lot of experience that I think regulators here and abroad can use now to do a complete review, specifically around these individual actions and the interaction among them, because there is an interdependency. And in doing so, I would also add that we obviously went through a tumultuous time 10 years ago, and we've done an enormous amount of work to address the results of the crisis, and these are extremely highly capitalized institutions, as we've talked about. I think no one really wants to go back and turn the clock on that. We're not looking about going back to the future, if you will. But we do think it's important to take stock of what we've done and make sure that we're doing it in the most cost-effective way possible.
Thank you. Mr. Baer?
Just a couple of thoughts. I mean, first, I do think it's important to acknowledge how tough capital regulation is. If the regulators come up with something very granular, we criticize them for credit allocation. If they give up and go to a leverage ratio and say every asset has the same risk, we criticize them for not thinking things through. So I'm sure there's some medium in there, but it's not so easy and happy to find. And so they deserve our empathy, and they also deserve our notice and comment on that. I think we touched on it a little bit today, but I do think the unseen world of bank examination is as important as the overt world of bank regulation, and that there are a lot of requirements going on out there that we don't even know about, and that it's very important for this committee and others to focus on. I would also just say, although I share the enthusiasm about equity, I did want to put in a word for debt, particularly for larger institutions that issue debt to the markets. That now, post-crisis, the way resolutions are conducted is actually quite loss-absorbent and protects taxpayers, and there's about $1 trillion of it out there, at least for our members. And it also brings into play a group of investors and analysts who are quite worried about losing their money and also exert a significant amount of market discipline. So I think that's a benefit. And I'd also add that, you know, post-crisis, I think there have been at least a GAO study and a couple of other academic papers looking at post-crisis debt pricing spreads, and there's no evidence that large banks are receiving a premium in the market or a discount, however you want to look at it, or that they're being able to issue cheaper as a result of some too-big-to-fail premium. So that's really market debt. Of course, the easiest way to figure it out, it's market debt, is to turn on a Bloomberg machine and see that it's priced the same way market debt is for other large institutions in other industries.
Okay, thank you, Dr. Holseeken.
Well, I applaud the committee for holding this hearing. I think it is a good time to do a holistic review of the regulatory apparatus, and I would encourage the committee, the regulators, to look at these institutions holistically. I think the thing I find most troubling about many discussions is the notion that we can separate systemic risk over here and get a capital charge for that, sort of prudential regulation over here, enhanced prudential regulation up here, liquidity regulation over here. That's not the way the world works. And one of the reasons I think a more robust stress testing regime is desirable is it takes a holistic look at the performance of the institution through the stress, and I think that should be the focus.
Very good. Dr. Stanley?
Yeah, a couple thoughts. One is I think there tends to be this trend or pattern that whenever we see a change in behavior by banks in response to new capital requirements, that this is somehow a cost or a bad thing, and I don't think that's true. Mr. Noriega talked about how U.S. subsidiaries of foreign banks have decreased some of their capital markets activities in the U.S. Because of the intermediate holding company rule. Well, I don't think that Credit Suisse or Deutsche Bank CDO desks activities before the crisis were doing any favors for the U.S. economy, nor were there enormous credit lines where they borrowed all these dollars in the U.S. and then couldn't pay them back without Federal Reserve assistance. Those capital markets activities were not doing anybody any good, and the idea that they might have become more responsible about those activities, I think, might be a positive impact of the IHC rules. And also, just in terms of this competitiveness, the argument about competitiveness with Europe, I mean, I think it's pretty clear that the U.S. banking sector is in a lot better shape than the European banking sector. There are still major concerns about the weakness of that sector, and to some degree, I think the higher prudential requirements in the U.S. have been a competitive advantage for our banks because people know that our banks are safer and sounder and better to deal with.
Mr. Noriega.
Well, thank you, Mr. Chairman. Thank you for having me here today. I just want to conclude by saying, look, I'm very optimistic about the banking sector, about the regulation of the banking sector. I think with the passage of the new law and the new regulatory heads finally in place, we have a real opportunity to take stock, to look at all the regulations that have been put in place and how they've been enforced over the past 10 years. I think when we talk and we hear particularly the Vice Chairman for Supervision at the Fed talk about tailoring and transparency, those are welcome thoughts in the bank regulatory sphere. And I think now the devil's in the details. And to me, the details are a soup to nuts review of how all of the cumulative effect of these regulations have impacted the various segments of the financial system. In particular, I think, are the subsets that I talked about today, those in the $100 to $250 billion range, which is going to merit a review by the Federal Reserve, and those in the foreign banking realm. But again, I think we have the approach here now to take a look and to tailor and to make more rational our regulation of these banks, and I think hopefully in a few years we'll reap the results from that. Thank you.
Well, thank you, and thank all of the witnesses today for their testimony. It's been great. You guys are fantastic. Without objection, all members will have 5 legislative days within which to submit additional written questions for the witnesses to the chair, which will be forwarded to the witness for the response. Ask our witnesses to please respond as promptly as you are able. Without objection, all members will have 5 legislative days within which to submit extraneous materials to the chair for inclusion in the record. With that, this hearing is adjourned.